Welcome, everyone, to another episode of the Eitel Insights podcast. This is your podcast host, Andy Park. And we're going to have a little bit of a different flavor to tonight's podcast. We're going to be taking a look at other jurisdictions across Canada. So, as we all know, the theme of most of our episodes have been on the Vancouver housing market, just because it has been quite a bit of an interesting one. There's a confluence of factors that affect recent price movements. But from an investor standpoint, we know that we want to look a little bit less myopically. We want to look at different opportunities in Canada, even globally, and particularly starting across the some of the more bubbly areas in Canada. So we want to take a look at Halifax. We've spoken about this before. So this episode is really geared towards people who are a little bit more open to other investment opportunities. So a lot of the message that we've been driving is that Vancouver is experiencing a lot of headwinds in the market. So what we want to explore today is, are there other different dynamics in Canada, and are there ones that are a little bit more attractive from a buying standpoint, despite the different strategies that sellers can use to either mitigate risk or take advantage of downward pressure. So we'll get right into it, introducing our lead analyst and founder of Eitel Insights. Dane, how are you doing today?
Excellent, Andy. Good to be with you as always.
Perfect. So should we dive right in?
Let's get into it, bud.
Okay, so let's start on the opposite side of the country. We want to take a look at the Halifax housing market. Can you give us a bit of a synopsis on what's been happening lately?
Yeah, Halifax is it's basically in a nut shape or nut form. It's in a growth phase right now, which is exciting. Especially as most of Canada properties are kind of dwindling in value, especially here on the West Coast. It seems that the East Coast is thriving. So in January, we actually did, I believe it was our first podcast, and we put some notes on the Eitel Insights website as well, stating that we saw Halifax as an investment opportunity. At that point in time, we were noticing a divergent trend. Now, what a divergent trend means is prices have lower highs, so they're continually going down from 320, 315, 312, and they can't seem to get it higher. At the same token, we were seeing prices on the downside increasing. So we were seeing, from 289, 292, 293. So prices were steadily hiring at the low end and steadily dwindling on the high end. Mm-hmm. So that basically kind of comes to a decision point where the two confounding thoughts flush themselves out. And as we prescribed, the market shot up, and shot up so hard, in fact, that in March it actually increased over 10% in one single month. Mm-hmm. So the prices went from $303,000 in January to over $330,000 in March. And of course, prices backtrack over a month, and then it's basically setting up a growth phase right now. So currently it went from $330,000 down to $317,000, and now back up to $325,000. So now we're seeing a steady increase of higher lows and higher highs, which it indicates that we're in a growth phase.
Okay, and just to be clear, this is for the detached market in Halifax?
Okay, yeah, good question. It's actually the aggregate for Halifax. So this is the aggregate market means townhouses, detached properties, and condos. So the whole psychological value of Halifax is on the rise.
Okay, for sure. So I don't want us to kind of give off the impression that we're only going to take a cursory look at some of these markets. We want to give a bit of an overview, but our intention is that we're going to do deep dives into each of these markets in future podcasts.
Right.
So kind of one interesting thing that we've talked about before is that Fort McMurray had a giant crash in housing values, particularly with the challenges that the oil and gas market experienced over the past couple of years. So what's happening now? We've alluded to the fact that there might be a buying opportunity in Fort Mac. Do we still kind of stick to our guns with that, or what's been happening?
Yeah, the data is showing that that call is coming to fruition as well here. Fort McMurray is a real interesting case. It was almost the case of Murphy's Law, and Murphy's Law is anything that can happen will happen. Yeah. You had a government change, you had the oil patch shut down, you had oil prices decrease, and you had forest fires, right? So government change thrown in there. You had a lot of factors hitting Fort McMurray in a not so pleasant way, let's say. So, prices actually peaked out here in 2012. In 2012, Fort McMurray properties on an aggregate basis were selling higher than Calgary on an aggregate basis.
Wow.
Right? Which kind of goes against common knowledge. You talk about Alberta in real estate terms, everyone thinks you're talking about Calgary or Edmonton. Mm-hmm. In 2012, everyone was talking about Fort McMurray, right? So that's an interesting thing. The fall from grace has been cataclysmic, has been... It makes for an interesting chart, right? But we're looking at things really just as data driven. If you can imagine, owning a property at 660,000 in 2012, and 6 years later your property dwindled to 350,000.
Wow.
That's a lot of money, and that's a lot of hurt.
Yeah.
That being said, we feel like that market has fleshed itself out, and it's found its base right around 350,000. We've tested that number a multitude of times. Actually, in late 2015, the market fell off, more than $150,000 in a month, right? And tested that line for the first time since 2005, 2006. Now here in 2018 and 19, we've kind of confirmed that is going to be our base point that was tested there in 2015. So the downtrend, it's not broken yet. However, the base seems to be put in there right at the previously established prices. And that's how we get a base of a market. At a certain period of time in previous history, that price was tested. At the time, the market shot up past it and said, we're not concerned about those price points. This place has investment opportunity. And now that prices are falling back, they're asking, where is this place investable again? We believe Fort McMurray is very investable again. And you truly will not hear that from too many economists. I mean, it was a difficult call for us in January, and you might hear a few economists come on board now just simply because of the government change. We don't call markets based on governments. We call markets based on analytical interpretation, right? So, I mean, the sales and the inventory, going back to kind of Halifax for a second, it's really switched over. The supply-demand factors have completely switched, where inventory used to be a lot higher above sales. Now we're not seeing that. Sales are eroding inventory, and you won't be able to keep up with the amount of demand here over the next coming years, which really creates a bidding war, an investment area. And Fort McMurray, it's obviously not there yet because it's not in a growth phase. It's looking for a rebound. However, our leading analytical indicators show that, the sales and the inventory, they're in divergent trends. Once again, in a divergent trend, when a winner is established, it's a clear and obvious winner. We don't really see too much more downside in Fort Mac, and we do see some upside. Now, am I saying that by 2022 we're going to see all-time highs in Fort McMurray? No, not necessarily. Are we going to see properties at 340,000? Once again, no. We will see a reversion back up towards the 760,000 price point, right? Is it going to be there overnight? Probably not, but is it an investable area? Absolutely. Not to mention, these places that we're talking about here with a 303,000 average sale price in January in Halifax, and currently, 325, and in Fort Mac, right around 350. Those prices are a huge discount compared to Greater Vancouver prices, right? I think the aggregate price around Greater Vancouver is right around $1 million. So that's $700,000 less. Now, if you're looking to make your start as a real estate investor, these aren't the worst ideas in the world, especially Fort McMurray. Maybe it's something a little bit closer to home. You have some family out there, and you can maintain that investment property, and you will see some return on your investment over the next couple of years. And going longer term, it's a great investment. Real estate prices long term do go up. Fort Mac in particular is a more macro basis, right? You got oil, you got gas, you got a lot of other factors. Those don't need to go through the roof for that area to be investable again, because all those areas tanked. As long as they show some kind of a base, of course, real estate will come back to that area as well.
Okay, for sure. So for our listeners here, the natural question that's probably popping up in your minds is, well, how much time do I have to invest in Fort Mac? If I am an investor, do I need to pull the trigger now, or do I have a little bit of leeway to be able to make this decision? And before we address that question, I do want to point out that obviously the core business of Eitel Insights is to give based on raw data, but obviously in-depth technical analytical interpretations, actionable intelligence that you can actually use to make these types of decisions. So, Dane, I won't put you in an awkward spot to have to...
Just a little awkward though, right? Exactly, there we go. I like it.
To have to answer the question about how long investors have. But to get those answers, naturally, you can visit eitelinsights.com. You can buy the Fort Mac report. It's $250. You can do a bit of a deeper consultation with Dane and get a little bit more customized information based on your investment needs. But I do want to address the fact that and I myself am thinking, well, how much time do I have to invest in Fort Mac? And I would just say refer you to our website, eitelinsights.com, and pick up a report, and we can dive in depth into this.
Yeah, we have a different level of membership, and with membership comes privilege, as everybody knows, right? As you stated, our static reports, our basic reports, which which aren't very basic. They're still very, convoluted and important. I mean, it offers actionable intelligence right across the board. They start at $250. I mean, for per property purchase, we're talking significant cash. This gives peace of mind in a lot of ways, shapes, and forms. But to not dodge the ambiguous question, I mean, put it this way. If I had $10 to invest and my three choices were Greater Vancouver, Halifax, and Fort Mac, I'd put $5 in Fort Mac and $5 in Halifax, and I would just leave Vancouver strictly on its own for the foreseeable future until that place becomes an opportunity. Okay. But, as far as timing goes, timing is important in real estate, right? Had you bought in 2016 in Fort Mac, I mean, you're hurting. You're hurting for certain, right? So, I mean, timing is very important. You wouldn't go wrong by making a purchase in Halifax or in Fort McMurray today with a 2-year outlook. And that's what we like to offer. As you state, we offer actionable intelligence. Greater Vancouver, you hear a lot of economists, analysts, and truthfully, Eitel Insights, we were a big proponent in these forecasts. And not just because we offer them, but because we're singularly right. I mean, we're so correct. We're within 1 percentage points of our year out, 2 year out forecast, right? Mm-hmm. So you hear of other companies giving up forecasts now. Mm-hmm. One thing I will just caution the listeners, take a look at what company they're with. I mean, I hear even marketing companies are coming out with forecasts now. Well, they kind of have a bit of an ulterior motive, right? So they're saying it's a great time to buy a condo. And then their asterisk is, with a 10-year, 15-year outlook. Mm-hmm. I would wager another $10 that if you ask them today to purchase that condo that they're advising a potential customer to purchase, would they buy that with the intention of flipping it within 1 year? Same price, no updates, no renovations. Would you anticipate a profit or a loss? Mm-hmm. And if they said profit, I would wager that they're either lying to you or very uninformed, right? So, there are specific reasons for always buying. Mm-hmm. However, Greater Vancouver isn't an investable area quite yet, as opposed to Fort McMurray and Halifax. They would be investable for us.
Yeah, for sure. And I think that's a good point. We're not here naturally to denigrate other analytic vendors. We would just encourage you to see where the allegiances lie and what their affiliations are. Going back to your point that you made, that if you had $10, you'd invest half in Halifax and half in Fort Mac. So kind of going back to that thematic line of thought, let's address the elephant in the room. How many of those $10 do I invest in Toronto?
Toronto right now, I wouldn't be putting any of it to work in Toronto.
Why?
Toronto, now it's interesting, right? This is the only market that hasn't gone absolutely our way within the month that we forecasted. Mm-hmm. I'm still expecting Toronto to be falling off here, right? The fundamentals in Toronto are similar to Vancouver. They have the stress tests, a lot of other factors. Now, one thing I would like to point out, though, and it isn't very common thought, the common thought is that Toronto is still kind of trudging higher. That's not exactly the case. It is trudging higher compared to 2017 prices. However, in 2016, the peak did occur at 920,000, right? So currently it's at 832,000, roughly still 10% off of the top, right? So we're not breaking all-time highs in Toronto, as the media would really have you believe that it's strong. I would say it's stable, however, coming off of a lofty area. So when you go from lofty to stable, what would be the next anticipatory step would be a recession, a significant fall off. That's what I am expecting in Toronto. It's retested, or it's kind of come back up to the bottom line of its uptrend that was established in 2015. So it's kind of its last gasp to say, hey, I'm still with this growth trend. So I would, at the most, a quarter, and I said in January 2 quarters that the market should fall off. We're right at the end of that, of the second quarter. So, within a month or two, we should start to see some significant downward movement in prices. And again, our leading indicators like the relative strength index, it showed a snap back up to the test of the growth phase and a significant fall off that has occurred. Now, that RSI usually does lead the market, 4 months to 6 months in terms of price point. Again, the supply-demand factors, they're narrowing, where the demand saw a peak, saw a lift up in February and March. And that can be attributed to a fairly severe winter in Toronto, right? And then you see that built-up demand that never really got out of the house, never got a chance to purchase, and they purchase in spring. Totally makes sense, mixed in with the fact that June and May are historically Toronto high prices. it stands to reason it hasn't fallen off yet. However, I wouldn't be putting any money to work there, and I would expect those prices to go lower. From 832 at the very least. I believe that the market will test 630,000 as a beginning of the base, and roughly closer to 6 before this market's all said and done. So from 832 down to 600, that would be my anticipated price movement upcoming. So no, I wouldn't put $10 to worth to lose that kind of money upcoming.
And that's sort of the beauty of technical analyses, right? I mean, you can have. Fundamentals are obviously important and they contribute to the analyses, but the reason that Eitel Insights is able to scale and perform these in-depth prognostications is the fact that the system can be applied relatively agnostic of specific jurisdictional factors, right? So,
and I mean, that's it. There is the fundamental difference between a fundamentalist and a technical analyst, right?
Exactly.
And we can debate which one has more merit. I think both have merit. I mean, 100% of, I am a technical analyst by passion and trade, but, so let's just use Fort McMurray, right? It was progressively in a downtrend, and then you had the fires, you had the oil patch dry up, you had a government change, and those are all fundamental factors as to maybe why you wouldn't want to invest in it. However, I look at the charts and say, well, that's why I don't want to invest in it, is because it's in a downtrend, right?
Sure, yeah.
And where technical analysts think we got the leg up on the fundamentalists is we're noticing a bottoming factor before you see an increase in the gas sector, an increase in, or a government change, which has occurred here in Fort McMurray. It's gone back to the conservative government, which historically does better for the oil and gas industry. So, we see these technical indicators as change upcoming. Analysts don't know what the name will be called. However, we know that there is something upcoming. So, for example, in Greater Vancouver, when the market was topping out, I mean, I didn't know that there was going to be a foreign buyer's tax and a government change here in Vancouver and then a stress test on a national basis. However, the technical line said there's something upcoming here where there's going to be a lot of equity lost. It wouldn't be a time to invest. As opposed to Fort McMurray, there was no real good news. However, the charts kind of showed that maybe this time to invest is upcoming. Now we're starting to see some positive changes in those areas. So yes, I believe technical analysts have a little bit of an edge over a fundamentalist, because the fundamentalists need the event to transpire to put a name to it. Technical analyst says something's going to happen, and then eventually the name shows up.
Yep, for sure. And I think to a certain degree they're linked, right? I think
I just have a natural bias, of course.
Exactly, for sure. In the few minutes that we have left, I do want to take a stab at a few extra topics, if that's okay, Dane.
Sure, buddy.
So we've talked a little bit about the stress test. We've gotten a lot of email inquiries about kind of what it is, and we try to kind of distill it down to a consumable format. But I think what's really interesting about the stress test is that it's kind of caused the pendulum movement too far the other way. So there has been a little bit of mitigation of the stress test, and that's actually caused, at least in the Vancouver market, a little bit of a short-term bump in prices.
Right.
So can you kind of detail that phenomenon a little bit and explain what the stress test mitigation is and how that affected this short-term bump and what we can expect moving forward?
Sure. I'll try to simplify it the best I can. So let's just use easy numbers of $1 million, right? So let's say pre-stress test, I could afford $1 million mortgage. 2 weeks later, stress test is announced, and all of a sudden I have a mitigation in my purchasing power. So instead of $1 million, I can only afford $800,000. Same qualifications, same income, same everything. However, my new qualification is $800,000. So I mean, right then and there, I can't purchase the properties I had my eye on before that were priced $1 million. The interesting thing in the detached market here in Greater Vancouver, prices are down 17%. Right, so that's close to that mitigation factor of my stress test. Not to mention, it's been around for a couple of years. I know that it's tough to get into that market, so I've been saving my income, working a little bit harder so that I can capture that opportunity when it next arose. Well, it's semi here now, right? Especially in some areas, we're seeing some markets down 23% locally here in Greater Vancouver, and some other areas further down is 28%. But on average, in the detached market, Greater Vancouver, we're down 17. So you're seeing that mitigation of the stress test. Now, it's just saying that, I can afford $800,000, but the properties come down to $810,000. So now I can, in theory, go ahead and purchase. So that's what we mean by mitigation. Now, there was some headline news last week, that said, stress test reduction. Well, that was a good headline. But it was kind of an empty headline, right? The mitigate or the stress test reduction was simply just a mirrored effect because the mortgage rate had dropped. So it's the stress test is still 2% above your highest rate, right? So you can get 2.89, but you got to qualify for a 4.89 stress test, right? Yeah. So it was kind of really just a misnomer and more of a headline rather than any event-driven news that happened. But you will see some mitigation, and we're already starting to see some mitigation. As we said on our last podcast, I believe that we're not ready to break that 10-year uptrend, and so that, and I think that will continue to play out here as these next quarter of data sets come out. That we'll see an increase of that, above 1.510 nominally, but still above that number until we lead into next year. And what's happened? I mean, those stress tests affected people have just been pushed to the sidelines, just simply based on price, right? Some people are actually grateful because they're going, whoa, thank God I didn't buy, a year and a half ago, because look at the prices now. Yeah. And then other guys are saying, when can I get into that market? Like, I'm just itching to buy my property. I just, I don't like paying my mortgage or my landlord's mortgage. I want to be paying my own. So now, you have a pent up of buyers out there that really want to get into that market. So we would advise to keep your powder dry. However, of course, you're fully entitled to make your own purchasing decisions. And I think that we will see a little bit of a bump to the sales market, both in the condo and in the detached market. Condo markets are a little bit more specific. Not every market has dropped nearly as much as the detached. Detached does lead markets down and markets up. Condos usually do follow. Just kind of general rule of thumb, roughly a year behind the detached market. So, we will see kind of a mitigation of the stress test upcoming here in the condo market in months upcoming. But however, the detached is here now. Okay.
Last topic quickly that I wanted to address, and it's actually related to this condo market. I just wanted to reaffirm, because we've actually had a lot of people emailing in asking us to clarify our position. So for condos, given some of the challenges it's facing, in a couple of years, if we have kind of an old condo that's listed, that's right, say 20 to 30 years old, versus new ones that are being built that can't get sold right now, are there any advantages those old condos have in the market versus these new ones? And if the answer is clearly no, let's make that position clear. But what's
I mean, as we sit today, there you can still buy an older condo. However, the advice or that I would bestow would be to hold off on that specific type of property, right? Because you are going to get the condo cannibalization coming up. Okay. So I'll try to be quick here. The interesting thing coming to the Vancouver condo market is in 2021. There's going to be a ton of completions of buildings actually being built, like finished, occupancy permits given out, and the pre-sale purchasers, some of them will move in. Mm-hmm. However, a lot of them, I believe, will just walk away from their 15% deposit, as the market during 2021 should be roughly down 33%. Right. So you'll see a lot of people walk away from that, which means the developer will absorb back those properties and have to resell them. And we're actually seeing that in the market right now. Like, as we've mentioned before, I am a real estate agent. However, it's my timing is spent on this real estate analytics. But, I go to the offices and I hear it, for an assignment sale, which is a person trying to sell a property that he bought in a pre-sale. So the building's not ready yet, but you can sell that contract to somebody else so that they move in at that time. It's called an assignment. Vancouver people will know that, during 2016-17, there was all that strife going on about that because people were making egregious amounts of money with no real investment whatsoever. Yeah. So developers put in the contract that they have the right to refuse the assignment. Also, there could be some penalties involved in the assignment, like a 1.5% increase of your purchase price, no matter what you're assigning it for, even if it's a loss. Yeah. So there is those people that purchase the pre-sales that would love to put their pre-sale on the MLS, which is the public multiple listing sites. However, the assignment the contract says you can't advertise it. Mm-hmm. So it can be in a private sale on real estate agent's website, but it can't be on the public market. Mm-hmm. And the assigner or the developer has the right to refuse the contract and all of this. So once we actually see that occupancy and the completion permits come through for a building, you'll have the developers putting their properties on the public market, and you'll have all of the assignment people that finally get the chance to put their properties on the open market. Mm-hmm. So that's what you'll see by cannibalization. So you'll see a flood of brand new listings, brand new condo listings. Well, just as a natural buyer, people like something new, right?
That's right,
So, I mean,
yeah.
that's where you get that cannibalization of the old condo. Nobody will even want to look at it. You know, it's a 22, 25-year-old building. I'll go see it later.
Right.
However, you know, inevitably prices in those 22, 25-year-old buildings will come down to attractive price points, let's say.
Yeah.
If the building's been, got new roof, new pipes, new elevator, it's effectively a new building. Plus, it's got square footage, and then that's when you'll see a flight to the older buildings that you can renovate and you can make it your home. And then you'll see the attrition rate and condo prices just continue to drop off. Competition between new developers will heat up. There'll be gift packages. There'll be cash backs included in contracts. And, for all of these kind of lingos, if you're not 100% sure what we mean, feel free to send us an email. Like you said earlier, we love helping. We are a busy company, but there's a few of us now so that somebody will be able to get back to you.
Okay. That sounds great. And with that, let's wrap it up. Thanks again for joining us for another episode of the Eitel Insights podcast. And we'll see you on the next one.